Hi everyone, my name is Ambrose Ebuka and I'm super happy to see you all at the You2Can show with Octa. Today I have Tolu here with me, my trading mentee, and together we navigate through the essentials of Forex trading and work hard towards a goal of earning her first $1,000 in trading. Tolu, how are you doing today?
I'm good, I'm fine, happy to be back.
Yep,
So
I can
glad to
see
be
that.
back.
You're super
Yeah,
excited to be back. I can see. Have you been trading,
yes.
between the episodes, or maybe have you read some articles or watched some webinars about trading?
Okay, so no, I've not been trading, trying to be careful, but yes, I've been seeing videos, trying to understand the Octa platform, the website, yes, and then so many materials actually. I've been trying to
Yeah.
study them and then understand them.
I think it's really beautiful to have the understanding of these tools. They can help you, enhance your knowledge in trading when you understand the tools. And it's amazing that you're, trying to learn and understand how to utilize these tools in your trading. Before you dive into, actual trading, we're going to have a practice live sessions where I'm going to show you how to use these tools. So it's good. But so far, the videos you've watched and some of the things you've read, do you have any questions on trading? Is everything clear? Can I help you with an advice? Let me know.
Well, at the moment, I don't think I have any question. I think I understand. I want to
Okay.
believe I understand.
Okay. Okay. Well, in the course of this mentorship, everything is going to be more clear. And if you have any questions, you can always let me know, and I would answer correctly. Okay.
All right.
All right. Today we're going to talk about one of the most important parts of a trader's life. Do you have any idea what that is?
Most important part in a trader's life is to
Yeah.
trade successfully, make some real good profits, but at the same time, minimize or reduce risk, like
Yeah.
risk management, something like that.
Yeah, there are actually some other ones like psychology and all that, but we'll get to that in the course of this mentorship. And we have people already guessing the topic today in the comments. So I'll just let that go on for a second, and I would ask you some questions, or maybe one question, and maybe that will shed some light on today's topic, right? So when you're trading, Tolu, real account, demo account, do you ever feel excited or sad, or maybe on the contrary, happy? You know, do you ever feel these emotions when you're trading?
The word is anxious, like very anxious.
Yeah,
There's always this goosebumps.
yeah, it happens. It happens with trading. I know a lot of people just enter the Forex market, motivated, and probably after some trades, a few profitable trades, or even as they're starting the Forex market, they just feel like, yeah, I'm the king of the world, I'm the master of Forex, and they just have that mood and they come into trading. But after maybe few unprofitable trades, they start to lose that confidence and they start, having problems with understanding the basics, understanding the market. Now, in the Forex market, it's a dynamic, market, right? It's natural to face up and downs. And one of the significant aspects or key things that can impact your trading is risk management. Risk management can impact the results of your trades. Today, we're going to talk about risk management, and we'll go ahead and unlock the secrets of effective risk management that can help you protect your capital. So, Tolu, let's start with the fundamentals of risk management. Tell me, do you have any guesses? Do you have any idea what some of the fundamentals of risk management would be?
Okay, so I think you mentioned in the previous episode
Yeah.
when you were talking about take profits and stop loss.
Mm-hmm.
I think those should be like one of the major fundamentals. I'm not sure. I'm just thinking one of the major fundamentals of risk management.
Okay.
That sounds like risk
Profit stop loss.
management. So
Yeah, yeah. I guess we'll find out in the course of this training. Are you ready?
yes, I am.
All right, everyone.
Let's do
Before we
this.
go into the, did you say something?
I said, let's do this.
All right, let's do it. Hi guys, lots of you have seen those deposit bonuses that Octa offers. However, not all of you know what a bonus is and how to apply it. So let me guide you through the process. Watch this video until the end and grab your 100% bonus for more profitable trading. Let's go. The deposit bonus increases your equity and free margin. It helps you open orders with a bigger volume. So here's how it works. If you make a $100 deposit and apply a 50% bonus, you'll get $150 for trading. This way, you can open more orders with a bigger volume, potentially increasing your profits. Now, let me show you how to use it. Log into your Octa profile. Find the promo code section in the side menu. Enter the promo code U2CAN and tap activate. Initiate a new deposit method and choose your preferred payment method. You can choose from instant bank transfers, Nigerian local banks, Skrill, Netteller, and many more. Claim your 100% bonus in the checkbox and complete the deposit process. And that's it. Now you know what a bonus is and how to apply it. Good luck. Before we go into the things we have today and start the beautiful discussion about Forex and get Tolu to understand risk management, I'll just go over the disclaimer and we'll get right into it. Any opinion, news, research, prices, analysis, or other information discussed in this training or linked to this presentation are provided as general market commentary and do not constitute investment advice. So what are you going to learn today, right? We have 3 sections. In the first section, you understand what risk management is, what stop loss and take profit orders are, how, just generally position size and stop loss and take profit. In the second section, we'll talk about a trading journal and why it's important to have it. And in the final section, we're going to have a conversation on trading psychology, how to keep your emotions in control. But obviously, I'm going to go ahead and start with risk management. Now, what is risk management? So for traders, risk management is all about managing losses and making most of the gains. Prices in the Forex markets can change quickly and risks are inherent in trading. So traders must take precautions to protect their funds. So risk management are just basically steps that you put in to mitigate the effect of a negative trade in your account balance. Okay. Now, how can you manage your risk as a trader? First step, stop loss and take profit. Forex traders strive to protect their funds and manage and maintain a trading approach in the ever-changing Forex market by integrating risk management principles to their trading strategies. Now, we have 2 ways you can do that. This is the first and I would say one of the important ways that you should also integrate risk management, or one of the important risk management steps that you can have for your trading: stop loss orders and take profit orders. Now, a trader can set a stop loss order which indicates when they will exit an unsuccessful position. So stop loss order is like an instruction where you tell your broker that, the price is at this point, you're about to enter a buy or a sell trade. And what happens is that you want your broker to close the trade for you if the market moves against you. Now, you want the broker to close it at a point where you're comfortable with risking, right? So that if the market continues to move further down against you, you wouldn't be exposed to a significant amount of risk. That's what the stop loss order does. Now, for the take profit orders, it's where you tell your broker that you want to execute or close the trade, right? You want to exit, rather, that's the word. You want to exit a profitable trade if the market is moving in your direction. And what this does is, if the market moves in your direction and tries to reverse, because you already have a take profit order in place, the broker is going to automatically close that position and secure your profit for you. So even if the market goes back down into your trade, or even below your entry point, or above for a sell trade, whichever way, the point is your profit is secured by the broker at your preferred price. That's one way. The second way you can do that in step 2 is position sizing and risk reward ratio. Now, what is position sizing? It's volume, right? You understand what we call position size, lot size, volume, right? Tolu, do you understand what position size is? So it's important that...
Yes, I understand.
Okay, it's important to calculate each order's size in relation to the total amount of trading capital. Now, it's important that the position size or the lot size that you want to use for your trade is also in alignment with the trading account size. What do I mean by that? If you're trading a $1,000 account and you want to use 10 standard lot size, that would be too risky for that account. And you're exposing that account to a significant amount of risk. So you want to use a position size that can rhyme with your trading account, so that you don't have to risk so much, so that you still fall within the 1% to 3% risk tolerance. Then risk to reward ratio basically tells you how much you want to risk. You have to predetermine that and how much you want to make in reward before you execute a trade. For example, to ensure a reasonable risk to reward ratio, a trader with a $10,000 account balance willing to risk $100 on An order should aim from a profit target for at least $100 or $200. So you're looking at 1% risk for 1% reward at the very least, or 1% risk for 2% reward, 3% reward, and more. Okay, so this is just how to calculate the risk percentage. You have your profit. If you're going to be risking 1% to 2% risk, then your profit should be 2%, 3%, or more. And obviously, for a $10,000 account, like you have this example, 2% risk would be $200, 3% would be $300, and we have the risk, 1% and 2% risk would be $100 and $200. Now, even if this market goes against you, right, you just lost 1% or 2%, you still have 98% of your trading account balance to place more trades. So if it's 1% every day, you still have 98 days to at least 98 days, or at most 98 days rather, to place more trades and potentially make a profit. So do you understand why risk management is very important?
Yes, I do.
All right. The third step, how can you manage your risk? What are the things that you should do? First, you need to identify your risk tolerance, right? How much do you want to risk on this trade? My risk tolerance may be different from your risk tolerance, and your risk tolerance may be different from someone else's risk tolerance, right? There's a lot of things that make up people's tolerance for risk. It can be your income, your personality, your understanding of the market. You want to understand your risk tolerance first, and then you want to look at leverage, right? Leverage is a two-edged sword, like I always say. It gives you the opportunity or the advantage to increase your profit, but it can also increase the potential for substantial losses. So you want to look at both ways and use a stop loss order, use a conservative lot size, so that while you're exposed to making more profit, you're also preserving your account should the trade go against you. Diversification. Now, you can always spread your orders or your trades across multiple assets. When we had, I think in episode 1, when I was introducing you to Forex, I told you about the things that are traded in the Forex market. What are these things that are traded in the Forex market, Tolu?
Commodities still came first in my mind.
So commodities are going to come first, obviously.
Currencies.
Okay.
Commodities.
Stocks. You can trade all this with Octa. And when you diversify, when you're diversifying your portfolio, you're not just trading just one currency or just one instrument, you're diversifying. The overall portfolio is less likely to take a hit from a single unsuccessful order. So if you're looking at placing trades on, gold and also GBP, and you're looking at stocks, and if gold goes bad, it may not affect the crypto, it may not affect GBP USD. And if you're trading oil or stocks, it may not also affect that as well. Right, so you're diversifying, but this doesn't mean that you should increase your risk. You should also keep your risk at a minimum. Finally, monitoring and adjusting, right? Keep a close eye on your open positions. It's very important. You don't always have to look at it, but once in a while, check your trades, see if the markets are giving you a reason to exit that trade or even add more positions. As the market dynamics change, you can, modify your take profit and stop loss levels. Put your stop loss into profit if you're in deep profit so that you can secure a good amount of profit, or you can put your stop loss into break even, and break even is where you execute the trade, the entry price, so that if the market reverses, it's a no win and no lose trade for you. So what are stop loss and take profit orders?
Okay, so let me just complete your sentence. An automatic order that you give to your broker to end a trade, so as to mitigate losses or to reduce a loss, to end a trade. Okay, yes, that's it.
Or what are take profit orders?
Exit a trade. Okay, so take profit orders are, should I use the word orders? Okay, commands that you give to your broker to also end a trade, but at a profitable, what's the word now? I'm looking for the word, but making profits.
Yeah,
so as to maximize a trade. Yes.
Okay. Why are they important? Why are stop loss and take profits important?
Okay, so to reduce losses, for stop loss to reduce loss, and for take profits to make profits. Take advantage of your trade.
And even if the market reverses against you, you've already closed the trade and you've secured a good amount of profit. Now, why are stop loss and take profits important? I'm going to give you 5, 6 or even 8 reasons why stop loss and take profits are important. And you answered very well as well. I'll give you that. I'll just give you some extra reasons why they're important so that you can keep that in mind and also implement that to your trading.
Meet Octa Trader, an innovative trading platform with a cutting-edge analytical feed, all in one to help you reach your investment goals. With one trading flow across all devices. How to start trading with Octa Trader? Download the Octa Trading app and sign up. Now proceed to create your real trading account. And once it's ready, make a deposit. Choose suitable payment method and collect your deposit bonus. But before you start trading, explore Space, a customizable trading feed where you can select assets to follow and choose topics that suit your interests best. Find relevant ideas for your trading style and gain confidence in your decisions to trade with profit. Give instant feedback on trading ideas you like. Get to trading seamlessly from the feed and open an order in a few clicks. You can also set stop loss or take profit right away. Create your own strategy with other built-in tools like our indicators and our drawing tools. Create your pending orders precisely. Set the desired price. Edit or cancel at any time. All your trading statistics in one place. You can get notifications across all devices to be up to date on all relevant market events. Now you are all set for trading with Octa Trader. Start today.
Number 1, risk management. A stop loss order helps you safeguard your capital and avoid big losses. A take profit order helps you avoid being greedy and lock in gains at advantageous levels. Number 2, emotional control. You can stay committed to your trading plan and control your emotions when you already have your predetermined exit and entry levels before you execute the trade, okay? So you predetermine these levels before executing the trade. And that way, you've controlled your emotions, the greed, the fear, that would be controlled. Approach and trading strategy. The stop loss and take profit orders are important because you can use them to plan your trade and define your risk to reward ratio systematically. This is also going to increase the profitability level of your trading strategy. It's going to give you more confidence to place more trades as well, give you more confidence to understand the market and make you just comfortable to, be able to perceive the market. The 4th reason is defense against uncertainty. Now, the market is a dynamic market, like I always say. So because you have your stop loss and take profit in place, you already know how much you're risking, how much profit you want to make. So even if the market goes against you, your stop loss orders would prevent you from suffering huge losses due to the volatility that comes with unanticipated movements of the market. Number 5 importance is effective time management. Now, you can automate your stop loss and take profit orders. They are automatic orders, so you don't always have to manually close them. That has saved you time of always checking to see where the market is. Once you place the trade, put your stop loss and take profit is automatic. You can go ahead and do what you want to do, go about your day. If the trade goes against you, you would be stopped out from losing a lot more money than you would have without the stop loss. If the trade goes in your favor, a good amount of profit would have been secured for you as well. And you didn't have to just always check your phone, right? The 6th importance is risk to reward ratio, TP and stop loss levels, which is take profit and SL. So when you see TP and SL, it's basically take profit and stop loss. It helps you as a trader determine the risk to reward ratio of each order. And it's very useful for ensuring that the amount of risk involved in each position is proportional to the possible reward. So if your stop loss is set at, let's say, 20 pips, right? Your take profit would be set at least 20 pips as well to give you a 1-to-1 risk to reward. So that way the calculation is just easy and you know that, okay, a double of 20 pips will be 40 pips, which is a 1-to-2 risk to reward ratio. Margin call avoidance, right? So a stop loss order and a take profit order, most importantly, a stop loss order would, help you avoid margin call. Do you remember when we talked about the terminologies used in Forex and I explained margin call?
Yes.
So margin call is that notification you get from your broker that you need to add more money to keep your open positions and keep the trade running. Now, if you have stop loss implemented on your trade, They're very useful for avoiding margin calls that are caused by unsuccessful or excessive losses or unsuccessful trades. That way, if the market moves against you, you're stopped out even before it gets to the point where you're risking 100% or 90-something% of your trading account, and the margin call notification comes in. And finally, stop loss and take profit are important because it gives you the ability to adjust to market conditions, right? So if the trade is moving against you, you can see that the market or the stop loss order closes that trade at your preferred price where you want to halt the further advance in losses. For a take profit order, when the trade moves in your favor, you can always adjust your stop loss into profit so that if it reverses, it closes at the stop loss price, which is going to be in profit. And at the end of the day, you make a lot of money still from a trade that hit your stop loss because it was in profit. So that way you're adjusting to market conditions, and it gives you that flexibility to always make a profit or minimize your losses in the Forex market. 8 importance of stop loss and take profit. Do you understand them?
Yes, I do.
So now we're going to move on to position size. What is a position size and how can you calculate a position size? Are you familiar with the term position size in Forex?
A little.
So position size is lot size and it's also volume. So are you familiar with the term lot size?
Yes, I am.
Okay, yeah. So it's usually called lot size, but it's the same thing. Position size, lot size, it's all the same. So that you don't get confused when you read some articles about trading and you're confused and you're like, what is this? What is position size? What is lot size? It's the same thing. Okay?
All right.
All right. So we're going to talk about position size right now. So a position size or a lot size describes the number of units a trader is buying or selling in an order, right? It's just the amount of units. How many units are you buying? How many units are you selling? If you're using the standard lot, like we discussed in the previous episode, the standard lots, the mini lots, the micro lots, how many units are you buying for one standard lot, 5 standard lots, and so on? And you can see here, just to recap, standard lots, mini lots, micro lots. One standard lot is 100,000 units, which means 5 standard lots would be 500,000 units, right? 1 mini lot would be 10,000 units. 1 micro lot, 1,000 units. 5 micro lots would be how many thousand units?
5,000.
5,000, which means that if the value per pip for 1 standard lot is $10, the value per pip for 5 standard lots would be how much?
The value per pip for 5 standard lots will be $50.
$50, great. If the value per pip for 1 micro lot is 10 cents, the value per pip for 5 micro lots will be how much?
50 cents.
Correct. Okay, so what determines the position size? What determines the lot size, right? As a trader, if you want to execute a trade, how do you know the kind of lot size that you want to use for that trade? I think that this is a very important aspect of understanding how the lot size work and how to use it. So first, you want to look at your account size. How much do you have in your trading account? Now, Tolu, if you have $1,000, are you going to use 5 standard lots to execute a trade?
Nope. That should be mini lots.
You should use a mini lot, right? Okay, you can even use a micro lot as well. It all depends on market conditions. But when you go higher with the lot size,
rather micro.
When you go higher with the lot size, you expose your trading account to a significant amount of risk. And talking about risk, another thing you should understand or you should check would be your risk tolerance. Now, today you may want to risk 1% because of what the market is telling you. Tomorrow, the market can show you something else and you'd also want to risk 2%. But it's very important to keep it from 1 at the very least and 3 at the very most, 1 to 3% risk, so that you can stay in the market long enough to place more trades. But if you always want to stick to 1%, it might be difficult because the market is dynamic, right? You're not always going to use a certain amount of pips for your stop loss on every trade. So risk tolerance is important. Your stop loss order is also important because when you identify where your stop loss should be, now you have the distance between your stop loss and your entry price. That distance alone can help you determine the lot size you want to use for the value of that distance. Do you understand the 3 things that determines your position size now?
Yes, I do.
That doesn't sound so confident.
Not totally, exactly.
So what don't you understand?
I'm trying to So account size.
Yeah.
Okay.
Which
Account
is
size.
the account in
That's
your
the amount.
the
The
amount
amount I have in
in
my
your
account.
account. Yeah. And then you
Okay.
have risk
Risk tolerance.
which is how much you want to risk.
How strong my heart is.
Yeah, and how much you want to
Then
risk. And your heart should not be
okay.
strong to risk 50%, please. Your heart should be strong to keep
Okay.
the risk at a minimum, right? 1% to
Oh,
3%. No matter how strong your heart is, don't risk 50% on the trade.
okay.
And then
Stop
stop loss.
loss order.
So when you determine your stop loss level, 20 pips, 30 pips, 10 pips, even 50 pips, 100 pips, that way, you know the value of that 100 pips, right? The distance between your entry price and the stop loss would help you understand how many lot size you should use for that distance that will fit into 1% to 3% risk. Now, the lot size you use for 100 pips is not the same lot size you use for 10 pips. Do you understand?
Okay.
And I'll show you
Yes,
the
I
calculation in
understand.
the next slide. So how do you calculate your position size, right? Here's the formula for calculating your position size. First, you need to determine the value per pip, right? Now, one way to do that would be your risk amount by percentage, which is account size risk percentage, the risk amount by percentage. Let me tell you what that means. If you have a $1,000 trading account, $1,000 trading account, 1% risk would be how much?
I'm not really good with maths, so I'm trying to figure out what 1% would be.
So 1%, well, yeah, I think you said that earlier when we started.
1% should be 1% should be 10.
Exactly, $10. So $10 is 1%. So can you see my calculator screen?
Yes.
So the formula for getting percentage is, or one of the formulas, one of the fastest way I like to do it is the account size divided by 100 multiplied by the percentage, right? So if we're doing if we want to get 5%, the account size divided by 100 multiplied by 5, which is going to give us $50. That's going to be the amount for 5%. In this case, we're looking at 1%. So what's the formula again? Account size divided by what?
Divided by 100.
Multiplied by?
Multiplied by the number.
So how many percent?
By the percent we want to use, like give us 5.
Yeah, so how many percent are we using
10.
in this case?
We're using 10.
10%. So you want to risk 10% on the trade?
Sorry, 1.
So multiplied by 1, which is going to give us how much in dollars?
$10.
So do you understand how to calculate percentage now?
Yes.
So now, risk amount by percentage, which is going to be in the, how much dollars again?
$10.
In the example of $1,000, that's $10. So the amount here would be $10 divided by, let's assume that the distance to stop loss. Give me an example of a distance to stop loss. How many pips do you want to use for your stop loss?
Say 20.
20%.
That'd be too much.
20 pips rather.
Pips,
okay,
yes.
so what's the formula again? Risk amount by percentage divided by distance to stop loss, right? How much is the risk amount by percentage?
$10.
So risk amount by percentage, $10 divided by distance to stop loss, which is how many pips?
20 pips.
So risk
like
amount
magic.
by percentage is $10 divided by 20 pips. That gives us 0.5. 0.5 is 50 cents value per. Remember, we're looking for the value per pip. We're trying to get the value per pip. So we've gotten the risk amount, which is $10. We divide that by 20 pips stop loss. So what is the value for each pip? For each pip in 20 pips, what is going to be the value? We have 20 pips stop loss. How much is 1 pip in that 20 pips valued at? 50 cents. That's the value per pip. So, if you don't understand, you can tell me. I'll go over it again. We're trying to get the value per pip. So we're looking at position size. What is the position size you're supposed to use for a trade? How do you know the position size you should use for a trade to keep yourself within 1% risk, 2% risk, 3% risk? How do you calculate that? First, you need to know the value per pip for the move. Do you understand? So how do you know the value per pip? For the distance between your entry price and stop loss, this is how you get it. You get the value per pip by identifying how many percent you want to risk, right? So let's say you want to risk 1%. How much is that 1%?
Which is already $10.
Divided by how many pips do you want to use for your stop loss? The market has to tell you that. You cannot just say, I want to use 40 pips, because if you say that and you use 40 pips always, the market may not respect 40 pips. So let the market be the one to show you, we're using the swing low, we're using the candlestick close, we're using the ATR indicator, whatever it is you want to use to determine your pips should come from the market and not from your mind. Okay? You're trading what you see and not what you think. So you've given an example of.
So right now we're assuming that the market is giving us 20 pips, 20.
You divide that $10 by 20.
Okay, so this is a micro lot.
Yes, this is a micro lot. Yes. Now,
so this automatically,
by getting this alone, you're able to get the lot size you should use for that. Which is going to come in the next. Let me switch my screen back to show you that. Now you've gotten your value per pip. How do you now get the position size that you want to use for that trade? To get the position size, you take that value per pip, which is 0.5, and divide it by 10, right? 0.5 is 50 cents. You take 0.5 and divide it by 10. If you take 0.5 and divide it by 10, what you're going to get is 0.05, which is 5 micro lots. The formula for getting the position size you want to use to place that trade. Remember, the first thing you started getting was your risk amount, how much you want to risk, which was how much?
$10.
The second thing was what? The amount of pips, right?
Yes, and we're assuming we're using 20.
And these two things helped you determine what? The value per pip.
Per pip.
Yes.
Yes.
So the percentage, which is 1%, $10, the amount of pips, which is 20 pips. You divide $10 from 20 pips. And what did we get?
0.5.
0.5. What is 0.5? You got 50 cents.
50 cents.
Yeah, 0.5 is 50 cents, which means the value per pip for that 20 pips is 50 cents. 50. Now, let me give you an example, right? So let's say we choose to risk $30, 3%, and the amount of pips is still 20 pips. We divide it by 20. What do we get?
This is 1.5.
$1.50, right?
50 cents. Yes.
$1.50. 1.5 is $1.50, which means that the value per pip now, because we are risking 3%, the value per pip would be $1.50. Now, if we are to divide that by 10, what lot size are we going to be using? A mini lot, 0.1.
A mini lot.
Do you see now? Before, what we did was 10% divided by 20 pips. We got 50 cents. And we divide this 50 cents by 10, and we got 0.05, which is a micro lot. 0.05 is the amount of lots you should use for that amount of stop loss to keep you at a 1% risk. Do you understand now?
Okay, I think where I'm getting confused is after we, at the point where we got the 0.5, which is 50 cents. So why are we dividing it by 10 again?
You divide by 10 because you want to get the lot size, the amount of the lot size you want to use for that trade. You have to always divide by 10 to get the amount of lot size. If you divide by anything higher than 10, you won't get the lot size. Yeah. So if you want to get the lot size you should use, you divide by 10. So even if your risk amount is $30, right? And the amount of pips, let's say you want to use 100 pips stop loss. Now, what do you have? 30 cents. What does this mean?
30 cents.
It means that each pip would be valued at 30 cents to keep you at $30 risk for 100 pips. Now, if you choose to use this amount of pips, 100 pips, what you'll be getting is 0.03. That's the amount of lot size you need to use for 100 pips stop loss to keep you at $30 risk. Do you understand? So whatever it is you get as a value per pip, you have to always divide by 10 to know the amount of lot size you should use.
Okay.
All right. So now that's how you get your position size that you would use for any trade. Do you have any questions for me? If you have any questions, you can go ahead.
So
ask me. You know, I always have questions for you. Right, Tolu? But the questions are going to come at the end of the session, right? The mentorship session. Yeah. So we're going to go ahead and get into section 2, where we discuss trading journals, and we'll talk about your trading strategy, the outcome and results, and some patterns and trends that should be included in your trading journal. Are you excited about this one, Tolu?
I am.
All right, guys, if that was too much information for you today, here's what you can do. You can take a break, take a walk, a cup of coffee, or even listen to your favorite music. Just come back tomorrow and watch the rest of the video. But if you're still full of energy, then let's move on. And don't forget to ask any questions you have in the Octa Nigeria Telegram chat, and I'd love to answer all your questions. So, you know that it can be challenging to stick to a trading plan, you know, follow one rule, follow some steps, and understand how to, you know, document every trade, stay disciplined to that. It can be challenging, and we're going to go into this section and discuss how you can, you know, position yourself to stick to that trading plan, discipline yourself, and stay consistent, so that in the end you can get the rewards that you want. You can achieve the results that you want. In this case, your goal again. What's your goal, Tolu? 1,000.
First $1,000.
So what is a trading journal? Now, Forex traders use journals as a systematic record keeping tool to track and evaluate their trading activity. It's like a journal, like a diary. You know what a diary is, Tolu? Is right?
Yes, I do.
Right,
yes,
how your day went, the achievements, the downsides, the decisions you made. That's the same thing for a trading journal. The idea behind each trade, right? I'll just go over the conditions or the things that are included in a trading journal. Conditions of the market. What was the market like? What was your analysis, your technical analysis? What were the economic events that were released that day that may have influenced the position of the trades that you took? Your strategy comes second. You know, what are the strategies that you employed to take that trade? This is regardless of if it's a profitable trade or a negative trade. You have to write it down. What are the strategies that you employed? What indicators did you use? How did you feel emotionally and psychologically? How did you deal with that? You put it down. The details, what are the pairs that you traded, the time of the order, the prices where you entered and exited, the position size. You want to write this down as well, because you're always going to come back to your trading journal as a beginner and learn and see if there's a transition from doing good to better and best, or doing good to bad and worse. You want to know if there's a transition, if you're actually increasing and improving or you're not, and you want to work on that if you're not. And the fourth thing included in the trading journal is what are the risk management steps that you took, stop loss and take profit orders, the levels, risk to reward ratio for the orders, risk percentage for trading capital that you used, your emotions when placing the order. Were you excited? Were you very confident? Were you less confident? Some external factors that affected your decision making. You put that down in your trading journal. Do you have a trading journal, Tolu?
Not at the moment.
Not at the moment. So after this session, are you going to get?
I have to. Yes, definitely.
Okay, that's great to hear. So the fifth thing that should be included in your trading journal is the outcome and results. Did you make a profit? Did you make a loss? What were the lessons that you learned? And then you have to do a post-order analysis, which is a reflection of what went well, what could have been improved, the mistakes. You know, this can help you know the areas that works perfectly for you, the currencies that work well, the lot size, the time of the trading day that works well, and you improve on that. Patterns and trends, you have to identify if you're making more successful orders than unsuccessful orders. Are you improving and continuing to improve, or are you reducing in your confidence on your strategies and your results? You want to know if you're improving or not, understand the trends of your success rate or your progress. And finally, a long-term performance analysis is also important. You have to look at the cumulative profit or loss over a series of orders. If you placed about 20 orders in a month, 10 orders in a month, what was it like? What was the profit over the loss like? Did you make more profit? Did you make more loss? Why did you make more profit and loss? Now look at the long period, like 6 months, 1 year. So if you're looking at your trading journal after each trade, maybe after each trading day, after each trading week, after each trading month, you also want to look at it from a longer perspective, right? 6 months, 1 year. What was your profit rate like? What was the average gain? What was the average loss? These are all included in your trading journal. Do you understand that?
Yes, I understand.
Would you be getting a trading journal now? Because I asked you and you said you don't have. Would you be getting one now?
Definitely, I will.
Imagine you're about to place an order, right? How do you know when to pull the trigger?
Okay. It's a big question.
I mean, it's obviously a combination of, I'm going to help you here. It's obviously a combination
so many things.
Yes.
So, let me try to answer actually.
All right.
Okay, so how do I know when to, while I'm still learning, I think I have to like study a lot of things, like study the market moves, check out news on Octa. I know Octa is always dropping, giving day-to-day news about the economy. Study the market and know where to set a trade, how to take profit, how to stop loss, and so many things actually, so many things involved.
You answered correctly. It's a step. You know, you want to be able to identify what's going on economically, what's going on technically, and you come to the chart and use the tools provided in the Octa Trader app or software for your PC. If you use a PC, you use all these tools and take advantage of them, use the trend lines. We're going to do a more practical session in probably the next episode. We're going to do a more practical session and I'll show you how to use these tools. And this is where you want to execute your trade with the Octa Trader app or software. You put the volume. This area is for the lot size that we just discussed. And after your analysis, you can either click on buy or sell. Now, this is a demo account, so I'll just go ahead and show you what it looks like. So let's say we've conducted an analysis, for example, and we want to use a 0.10 lot size and we want to buy. So we'll just go ahead and click. You see that executed pretty fast and the trade is already open, right? You can see that. So now we're going to go over the final part of a trading journal, and I'll talk to you about why it is very important for traders to have a trading journal. So why is it important to keep a trading journal? For performance evaluation, you can check the success of your strategies, identify the areas for development by going over your trades. Psychological awareness, you can look at the behaviors, the patterns, how you react to the trade before and after, the things that influence your thoughts, the things that influence your decision making throughout your trading day. Accountability, which is also going to help you stay, and this is something that a lot of beginner traders lack, you know, because you're not accountable to anybody. You just feel, oh, I'm going to do anything. I'm going to trade with any lot size I want. You have to create that sense of accountability to yourself, where you question the things you do, the decisions you make. You promote your self-control by making yourself, you know, answerable to the things that you do, making yourself accountable to you first and the goals that you want, because you're not going to get those goals if you're not accountable to yourself. You're not going to get the achievements you want if you don't question your decisions in trading. And finally, continuous improvement, right? If you want to continuously improve with trading, you want to have a trading journal that can help you reflect on your past wins, past losses, your past profit, past losses. You stay clear from blunders and mistakes, and you increase and, you know, perfect, or maybe not perfect, but improve your approach to trading over time. Okay, so these are the 4 important reasons why, or 4 importance why you should have a trading journal. Now, do you have any questions for me? Because I'm going to go over section 3, which is trading psychology. Any questions
No
for me,
questions
Tolu?
so far. No
All
questions.
right. So tell me, Tolu, how do you react to, a profitable trade? Do you get excited? How do you react to a profitable trade specifically?
Definitely excited.
You
It's
get
a
that
good thing.
rush, that happiness. How about an unprofitable trade?
I'm always humbled and humble.
You're always humbled.
Like, humbled and humble.
Well, I think regardless of the outcome of the trade, as traders, we should always be humble in every trade that we place, because you need a clear sight, you need a critical mind, clear-sighted mind as well, to help you identify and see the market clearly. So you want to be humble at all times in the market. If you're not humble, the markets would humble you. So
Humble
something
you.
we call emotional trading, right?
Okay.
And there's how you can avoid that. And we're going to discuss all this as we talk about traders' psychology. So what is trading psychology? The psychological and emotional factors that affect a trader's decision-making and behavior when trading various assets. Trading psychology significantly impacts a trader's success, and emotional biases can potentially cause bad judgment, stray from tried and true strategies, and eventually lead to setback. Now, in simple terms, trading psychology are the things that you think about and how you react to the market. What are some of the elements of trading psychology? Emotional control, feelings like fear, greed, euphoria, and worry. These are the things that can prompt rash decisions. They can make you either rush into a trade or miss out from a trade. And just that means you just have to move away from your strategy and start to make rash decisions. A lot of times that traders have good strategies, conduct proper analysis, but they now start to get scared that the trade could go against them. And what do? They don't take the trade, they miss out on it, and they watch the trade just go in the direction. And then the next time they want to place a trade, they're like, well, I missed out on the last one. I don't want to miss out on this one, so I'm going to use high lot size. And what happens? The trade potentially goes against them, and the confidence is reduced, and you just find yourself in a bit of a roller coaster. So you don't want that. Again, to eliminate that, you need to identify proper risk management and apply it to your trading to eliminate emotional control. Also, we're looking at discipline. Follow your plan, follow your strategies, your rules, whatever it is you've set as your plan, you have to follow it strictly. This can help you control your emotions. Patience is going to help you a lot in the market because you want the market to act for you to react. And one way to do that is to be patient. And patience is required when, refusing to act impulsively out of FOMO, which is fear of missing out. When you don't want to act out of FOMO, instead you're waiting for the perfect trading opportunity based on the plan that you've established, right? You can be scared. Oh, I'm going to miss out on this trade. Let me just take it right now. Otherwise, I'll miss out on it. I'm seeing the market. It wants to move. Let me just join. That way, if you keep saying that, market wants to move, let me just join. I just want to trade around before it moves. I want to catch a few pips and get out. If you keep trading that way, you're putting yourself ahead of the market. And you can't be ahead of the market. You want the market to act and you react. Objectivity, which is the ability to analyze market situations objectively and reasonably, right? So you want to look at the market and not just have an idea that, oh, I'm going to wake up this morning and I'm looking to buy. On a Monday morning, I want to buy. On Tuesday, I want to sell. On Wednesday, I want to buy. No, you want to come to the market, look at what the market is saying, make your decisions based on what the market is saying and not what you already have in your mind or your feelings or how you feel that day. Even if you're using fundamental analysis, looking at economic events, you still have to come to the charts and let the charts tell you the good areas and comfortable areas where you can take the trades. Resilience, which is the capacity to recover from setbacks without losing courage and to accept losses as a normal part of the business, right? There's some traders that once they make there are traders that come into the market and they say, Ambrose, how do I place trades without losing? What? How do you start a business? It's just like every other business, right? There is a potential for losses, but with trading, you can reduce that. You can minimize that, okay? The awareness of a potential losing trade in the market would help you avoid that losing trade. It's like embarking on a journey, and on this journey, you're aware of the areas that are dangerous, right? You can avoid those dangerous areas because you're aware of them. Even if you're driving, let's say you're driving at a road with a lot of potholes, now that you're aware that there are potholes, you can drive slowly. There are some lanes you can drive on, and if the other side is not good, you switch to the other lane. Like, you already have that idea that this is not a good road, or maybe it's a good road, yeah, but it's not smooth. So this is how I have to drive in order to get to my destination. The important thing is the destination, the goal, the achievement. And if you have to be aware of the losses in trading to get to that destination, be aware of it, implement strategies that can help you, understand how it works, and you can get the results that you want. So other elements of trading psychology would be adaptability, the ability for a trader to react to different market conditions and not start becoming emotionally invested in it, or prepare for a specific result from trading without understanding what's going on in the market. You should be able to adapt to different market conditions, and also for your mindset as well, how you feel, your mood for the day. Should you trade at a specific time? You could be upset about something that you come into the market and you want to trade. You want to be very relaxed. It's not really ideal to come into the market when you're not having a clear sight and you're not very much relaxed. So you want to be able to adapt to your emotions, different types of moods that you're in. Know the one to trade at, the one not to trade at, which is obviously you should trade when you're very relaxed and clear-sighted. And also the market movement as well, and the results you get from your trade. You should also be able to understand the dynamics and adapt to the different changes in market conditions. Second, or not the second, but another element would be risk management, which is obviously what we've stressed about today. We've discussed risk management a lot, about how you can mitigate the effect of a negative trade and reduce the impact of that negative trade on your trading account. Your mindset as well, which is where you get to develop a growth-oriented, optimistic attitude, prioritizing ongoing progress over reflecting on past failures or errors, right? And I said this when I talked to you about traders that would place a trade, and if the trade goes against them, then that trade starts to affect the next trade or influence the next trade. No, what you can do from a losing trade is you learn and you move on to the next one. What can you do better, right? You learn from it, you move on. The past trade should not influence your trading decision in the next trade. For traders, maintaining the balance between emotional and analytical sides of trading is essential for long-term success. This requires an ongoing understanding and management of trading psychology. So tell me, do you understand the elements of trading psychology?
Yes, I do.
Okay, so how are you going to keep your emotions in check? How are you going to keep your emotions in control? How do you make sure? And this is very important for beginner traders as well. So for those of you watching, pay good attention to this part. How are you going to keep your emotions in control? First, self-awareness, right? Very important. You should identify and accept all feelings, fear, greed, excitement, as they happen. Identify them, accept them. When you accept them, you're able to control them, right? Risk management techniques you should apply: stop loss, take profits, conservative lot size, risk to reward ratio. You can use these tools to reduce possible losses and emotional stress. Detachment and awareness, very important. Pay attention to the process instead of obsessing over specific results, right? Don't look at how much you want to make. Look at what the market is showing you. Look at if you're using a good strategy, if you're looking at the correct things, the true things that are happening in the market, not how much you're going to make from the trade. Your trade idea should not be determined by how much you want to make, but what the market tells you. You have to recognize that trading involves losses, and you have to distance yourself emotionally from the outcome of each position. And the one way to do that would be to determine your entry, your exits, your risk, and your reward even before executing that trade. Taking a break. Now, you want to take a break from trading during stressful times, because again, you want to be clear-sighted, you want to be in the best mind, you want to be in a good state of mind. And when you take a break from stressful times. It can help you restore your composure and also help you make wiser decisions in the market. Ongoing education and self-improvement. Learning never stops in trading. You want to constantly learn. You want to constantly improve your knowledge. And, when you do that, you increase your chance of staying consistently profitable in the Forex market, enhancing your trading skills as well. All right. We've come to the end of this mentorship episode with Tolu, the U2 can with Octa. This is the end of the episode. But before we wrap up and talk about what we have next for Tolu in the next episode, I'm going to ask you some questions, Tolu. I have 3 questions for you. And before I even ask you these questions, let me know if you understand and if there are questions you have for me.
Not really. I don't really have questions, but I know that I have to go back and watch this show again so that I can best understand and also practice.
Yeah, Tolu, tell me, before I ask you these questions that we have here today, how do you manage stress every day? As you go about your everyday life, how do you manage stress?
So stress. I actually try not to get to that breaking point, and once I see that I'm getting to that point, I take a break. Just stop. Catch my breath. Yes, catch my breath, and then maybe relax or try to get myself together and then come back. But I don't allow it get to that point where I break down.
That's a good one. You see that most of these things here, controlling your emotions and most of these elements of trading psychology also applies to your everyday life as well. As you can see here, you said you like to take a break, and you can see that even with keeping your emotions in control at some point, you're going to take a break and relax so that you can restore your composure and make wise trading decisions. So this doesn't apply just to trading, but to everyday life as well. And you can implement that. You, Tolu, and everyone watching, you can implement that to your trading and also your everyday life. So tell me, what's an example of a moderate risk to reward ratio?
Moderate risk to reward ratio.
Yeah.
That's 1 to 2 or 1 to 3.
Okay, 1 to 2, 1 to 3. Yeah, that's good. Is 5 to 1 a good risk to reward? 5 risk 1 is 5 risk 1 reward.
Gap is too wide. That's quite dangerous.
Okay.
Or that can be dangerous.
But you answered correctly. What are stop loss and take profit orders? Just like a brief definition of what they are.
An order we give to our brokers, or an order given to a broker to execute a take profit or a stop loss, to minimize risk and maximize profits. Or maximize profits.
Yep. And name 5 things that make up a trading journal.
Okay, so I know there's something about day-to-day experiences, what you trade today. Did you make profit? Did you have losses? Recording day-to-day trades. Wow.
Well, you can always come back and watch.
I can remember, but to break it down, I don't know how to.
Okay, let me just give you the answer, right? So for the but you did you said something about day-to-day profit, journaling your trades. Yeah, that's also included. So you want to journal market conditions. You mentioned something about journaling your trades. That's order details. Put down the order details, market condition, order details, the risk management steps that you used to execute that trade, post-order analysis, the trading strategy that you used, the outcomes, the results, the patterns and the trends in terms of, are you improving or are you, reducing in your progress, so that you can help yourself and even do more better. Identify the areas where you're not doing well and improve in those areas. So do you understand now?
Yeah, I do.
All right. So, but you can always come back and watch. And 2 out of 3, and for the third question, you still answered 1 out of 5. So you still did great. Okay, guys. Thank you everyone for joining us today. We've come to the end of the 4th episode of the U2 Can with Octa. And Tolu, tell me, what exciting thing or what were some of the benefits of this session, and what did you learn? How was it?
Okay, so I think the major benefit for me is risk management.
Okay.
Yeah, risk management and emotional control. Because
Emotional control. Okay.
yes, putting emotions in check and making sure that decisions are not made on the basis of emotions. Yes, risk management,
Okay. So
basically.
you're obviously going to work on
Because
your
we
emotions then.
definitely
And what else? There's one thing I told you to do.
to also get a journal, trading
Yep.
journal.
Get a trading
Yeah,
journal and also work on your
and make
trading
sure
psychology and your emotions as well. So your take-home assignment I'm going to give you today would be to place a trade. You could place a trade rather, or trades if you want to place multiple trades. Because I asked you earlier and you were like, you haven't placed trades, you're just learning. So put what you've learned into practice, place some trades and write it down on your trading journal. You know, the bias, the emotion behind that trade, the reason, what influenced your thoughts, all that. In the next section, we're going to discuss that and talk about some other important topics. I'll show you. Let me just go ahead and show you what we have for the next section. The next session, we're going to talk about fundamental analysis, where I introduce you to fundamental analysis, tell you how the news can affect the market, how to understand trading the news, and we're going to do some practice. But again, your take-home assignment or your home task here is to get a trading journal, place a few trades, practice, and journal those trades. And when you come back for episode 5, we will discuss it and go into fundamental analysis. For everyone watching as well, thank you for the attention and the comments that we've gotten. You can join our Telegram channel where you'd find links to educational materials and connect with like-minded traders that can improve your knowledge about Forex and increase profitability. And I'll see you guys in the next episode. Bye, everyone.